What controls exchange rates? A currency falls, not slowly, but suddenly. Yesterday, $1 bought 100 units of a currency. Today, it buys 120. No visible explosion, no breaking news headline, just numbers, quietly shifting. But beneath those numbers, something powerful is happening. Wealth is being transferred. Purchasing power is being rewritten. Entire economies are adjusting in real time, and most people never see it coming. So here's the question. What really controls exchange rates? Is it governments, central banks, global investors, or is it something deeper, something systemic? Because the truth is, exchange rates are not controlled, they are emergent. They are the result of multiple forces interacting simultaneously. Today, we're going to break those forces down, clearly, precisely, and at a world-class level.
Hello, I'm Miss Capital. Welcome to Real World Business School, where we break down how money, markets, and power actually work in the real world. Today, we're exploring a question that affects economies, businesses, and even your personal wealth. What really controls exchange rates? Because behind every rise and fall of a currency, there's a system of forces most people never see. In this session, I'll walk you through those forces, clearly, practically, and at a level that changes how you understand the global economy. Let's begin.
Understanding exchange rates. At its core, an exchange rate is simple. It is the price of one currency in terms of another. Like any price in an economy, it is determined by supply and demand. If demand for a currency rises, its value increases. If supply increases, its value falls. But currencies are not ordinary goods. They are 1. A store of value, 2. A medium of exchange, and 3. A reflection of economic credibility. So the forces that move them are far more complex than typical markets. The real question is not, what is the exchange rate, but rather, what drives demand and supply for a currency? The foundation, supply and demand dynamics. Let's build the foundation. Demand for a currency comes from foreign buyers purchasing goods and services, investors allocating capital, governments and institutions holding reserves. Supply of a currency comes from imports of goods and services, capital outflows, and currency exchanges for foreign assets. This creates a continuous global flow. A currency strengthens when demand exceeds supply and weakens when supply exceeds demand. But these flows are not random. They are driven by deeper economic forces.
Interest rates are one of the most powerful drivers of exchange rates. Why? Because capital moves toward returns. If a country offers higher interest rates relative to others, it attracts foreign capital. Investors convert foreign currency into local currency. Demand increases, the currency appreciates. This is known as interest rate differentials. However, there is a nuance. Higher interest rates can also signal inflation concerns, economic instability. So markets don't just react to the level of rates. They react to why rates are high.
Inflation. Purchasing power parity. Inflation erodes the value of money. If one country experiences higher inflation than another, its goods become relatively more expensive. Demand for its exports falls. Demand for foreign goods rises. This leads to lower demand for the domestic currency, higher demand for foreign currencies. Result, the currency depreciates. This concept is known as purchasing power parity, or PPP. Over the long term, exchange rates tend to adjust to reflect differences in inflation between countries. In simple terms, A currency that loses purchasing power domestically will eventually lose value internationally. Trade balance, the real economy. The trade balance reflects the flow of goods and services. Trade surplus means exports exceed imports. Trade deficit means imports exceed exports. When a country exports more, foreign buyers must acquire its currency. Demand increases. Currency strengthens. When a country imports more, it supplies its currency to buy foreign goods. Currency weakens. However, modern economies complicate this. A country can run a trade deficit and still have a strong currency if it attracts enough capital inflows, which brings us to the next force. Capital flows, the dominant force. In today's globalized world, capital flows often dominate trade flows. These include foreign direct investment, portfolio investments, stocks and bonds, and sovereign wealth allocations. When investors see opportunity, capital flows in, currency strengthens. When they see risk, capital exits, currency weakens. And these flows can be massive, far larger than trade flows. This is why financial markets have such a strong influence on exchange rates. Central banks, policy and intervention. Central banks play a critical role. They influence exchange rates through interest rate policies, monetary expansion or contraction, and direct intervention in foreign exchange markets. For example, a central bank can sell foreign reserves to support its currency, or buy foreign assets to weaken it. But there are limits. No central bank can sustainably override market fundamentals. Intervention works best when aligned with economic reality. Otherwise, it becomes temporary. Expectations and speculation, the psychology of markets. Markets are forward-looking. Exchange rates reflect not just current conditions, but expectations about the future. If investors expect strong growth, currency strengthens. Weak growth, currency weakens. Policy tightening, appreciation. Policy instability, depreciation. Speculators amplify these movements. They act on anticipated changes, and in doing so, often create the movement itself. This is the reflexive nature of financial markets. Political and economic stability, trust as a variable. At the deepest level, currencies are built on trust. Stable institutions, predictable policies, and strong governance attract capital, support currency value. Uncertainty, instability, and lack of credibility trigger capital flight, weaken the currency. In essence, a currency is a reflection of confidence in a system. So, what controls exchange rates? Not a single institution, not a single policy, not even a single country, but a system of interconnected forces: supply and demand, interest rates, inflation, trade balance, capital flows, central bank actions, market expectations, and institutional trust. Together, they create a dynamic equilibrium, one that is constantly shifting. And here is the final insight. Exchange rates are not just economic variables, they are signals. Signals of strength, signals of weakness, signals of confidence or concern. To understand them is to understand how the global economy truly works. If you want to master how money, markets, and global systems actually work, subscribe to Real World Business School. Because in a world driven by capital flows and invisible forces, the people who understand the system are the ones who move ahead of it.
Now you understand something most people don't. Exchange rates are not random. They are the result of powerful interconnected forces. And once you begin to see those forces, you stop reacting to the economy and start understanding it. If you found this valuable, stay with us at Real World Business School, where we turn complex global systems into clear, usable knowledge. I'm Miss Capital. I'll see you in the next session.